Imagine waking up on January 2nd and discovering that the biggest financial mistake you made wasn't a bad investment, a market crash, or a scam. It was simply waiting too long to make a decision. Every year, thousands of Americans lose thousands of dollars because they assume the tax rules will stay the same or that they can deal with retirement planning later. The truth is that the tax code doesn't reward procrastination. It rewards preparation. And if you own certain assets in retirement, doing nothing can quietly cost you far more than making a few smart adjustments before the end of the year. Today, we're going to look at 7 retirement assets that deserve your attention before the calendar changes. These aren't exotic investments or complicated strategies used only by millionaires. They're assets many ordinary Americans already own: cash sitting in savings accounts, traditional retirement accounts, brokerage investments, real estate, life insurance policies, Social Security income, and even the bank account you use every day. By the end of this video, you'll understand why these assets can create unexpected taxes, hidden costs, or unnecessary financial stress, and more importantly, what you can do to reduce those risks. Let's begin with the simplest asset of all: cash. Most people think cash is completely safe because the balance never goes down on the screen, but that's an illusion. While your account balance may stay the same, your purchasing power slowly shrinks every year because of inflation. If inflation averages around 3%, while your savings account pays less than 1%, you're effectively losing money even though the number in your account hasn't changed. Over several years, that silent loss can add up to thousands of dollars. Another thing many people don't realize is that banks follow strict federal reporting rules for certain cash transactions. Large cash deposits or withdrawals may automatically be reported to government agencies. That doesn't mean you've done anything wrong, and it certainly doesn't mean you're under investigation. It's simply part of the financial reporting system banks are required to follow. The important point is not to panic or try to avoid those reports by splitting transactions into smaller amounts. Deliberately structuring transactions to avoid reporting requirements can create legal problems that are far more serious than the report itself. Instead of letting large amounts of cash earn almost nothing, many retirees compare alternatives such as high-yield savings accounts, treasury securities, or money market funds that may offer better returns while keeping funds relatively accessible. Every person's situation is different, but reviewing where your emergency savings are held could make a meaningful difference over time. Even a few extra percentage points of annual interest can translate into thousands of additional dollars over the course of retirement. Now let's move to what may be the biggest tax challenge many retirees face: traditional IRAs and 401k accounts. These accounts provide valuable tax benefits while you're working because contributions often reduce taxable income, but eventually the government expects its share. Once required minimum distributions begin, many retirees discover that withdrawals increase their taxable income. At the same time, they start relying on Social Security and other retirement benefits. The challenge isn't simply paying tax on the retirement account itself. Larger withdrawals can also affect how much of your Social Security becomes taxable, and, depending on your income, may even increase Medicare premiums in future years. That's why retirement income planning is often more complicated than people expect. It's not about one account. It's about how every source of income interacts with the others. For some retirees, gradually converting portions of a traditional IRA into a Roth IRA during years with relatively lower taxable income may reduce future required distributions. Whether that strategy makes sense depends on age, expected future income, tax brackets, and many other personal factors. There is no one-size-fits-all solution, but understanding your options before required distributions begin can provide much greater flexibility later in retirement. The biggest mistake many people make is assuming they'll figure everything out after they retire. Unfortunately, some of the most valuable planning opportunities exist before retirement or during the early retirement years. Once required distributions begin, your choices become more limited. That's why reviewing your retirement accounts with a qualified tax professional or financial advisor before year-end can be one of the most valuable financial conversations you have. And we're only getting started. The next asset surprises almost everyone because something millions of Americans own without realizing it could generate unnecessary taxes. In the next part, we'll examine brokerage accounts, capital gains strategies, and one planning opportunity that many investors completely overlook until it's too late. If you've been investing for years through a regular brokerage account, you might believe the smartest strategy is to buy quality investments and never sell them. For many people, that approach has worked well, but retirement introduces a new challenge. The question is no longer just how much your investments have grown, it's how much you'll actually keep after taxes. Every share of stock, ETF, or mutual fund with a large unrealized gain represents potential future tax liability. The good news is that with careful planning, some of those taxes may be reduced or even avoided, depending on your income and the current tax rules. One strategy many retirees discuss with their tax professionals is capital gains planning. In certain situations, taxpayers with relatively low taxable income may qualify for a 0% federal long-term capital gains rate on part of their gains. That doesn't mean every gain is tax-free, and it certainly doesn't apply to everyone. But understanding where your taxable income falls before selling appreciated investments can make a significant difference. Sometimes selling part of an investment over several years instead of all at once results in a much smaller overall tax bill. Another detail many families overlook is cost basis. Your cost basis determines how much of your investment's value is considered taxable gain when you sell. If records are missing or incorrect, you could end up paying more tax than necessary. That's why it's worth reviewing your brokerage statements and confirming that the cost basis for every major investment is accurate. A simple administrative error can become an expensive mistake years later. Estate planning also plays an important role. Depending on how investment accounts are owned, inherited, and transferred, tax consequences can be very different. These rules vary by state and by individual circumstances. So, it's important not to assume that what worked for a friend or neighbor will automatically work for your family. Taking time to review account ownership and beneficiary designations with an estate planning attorney may prevent costly surprises later. Now let's talk about real estate, an asset many retirees consider their greatest source of wealth. Whether it's a rental property, vacation home, or commercial building, real estate often provides years of appreciation and rental income. But selling property can trigger multiple layers of taxation, including capital gains taxes and, for rental properties, depreciation recapture. Many owners don't realize how large those tax bills can become until they sit down with their accountant after the sale has already closed. Planning ahead makes a tremendous difference. If you're thinking about selling investment property, don't wait until you already have a beer before asking questions. Some tax strategies require planning well before the closing date. Missing an important deadline or filing requirement can permanently eliminate planning opportunities that may have reduced your tax bill. Another common mistake is ignoring the condition of the property itself. Deferred maintenance may reduce the selling price, while organized records of improvements can help establish a higher tax basis. Keep copies of renovation invoices, major repairs, and capital improvements. Those records may reduce taxable gains years later when the property is eventually sold. Real estate also raises important estate planning questions. Many families intend to leave property to children or grandchildren, yet never review whether ownership, trusts, or beneficiary arrangements still reflect their wishes. Laws change, family situations change, and financial goals change. Reviewing those documents every few years can help ensure your property passes according to your intentions while minimizing unnecessary legal complications. The key lesson is this: real estate should never be viewed only as a valuable asset. It should also be viewed as a potential tax event. Every decision, from how you own it, to when you sell it, to how it's transferred after death, can affect how much of its value ultimately stays with you and your family. We've now covered 4 major assets, and each one demonstrates the same pattern. The financial risk rarely comes from the asset itself. It comes from waiting too long to understand the rules that apply to it. In the next section, we'll move into 2 areas that surprise many retirees even more: the hidden tax issues inside permanent life insurance policies, and the way Social Security benefits can become partially taxable depending on your other sources of income. These 2 assets often interact in ways that many people never expect until they receive a much larger tax bill than they anticipated. Now, let's discuss an asset that many retirees assume is completely tax-free simply because they've owned it for decades: permanent life insurance. Whether it's a whole life policy or a universal life policy, many of these contracts build cash value over time. That cash value can become a valuable financial resource during retirement. The death benefit paid to beneficiaries is generally treated differently from the cash value while you're alive, and confusing those 2 concepts can lead to expensive decisions. Many policy owners eventually reach retirement and wonder whether they should withdraw money from the policy too. The answer depends on how the policy was designed, how much has been paid in premiums, and how much growth has accumulated inside the contract. In some situations, withdrawals may create taxable income. In others, policy loans may be available. Each option has advantages and disadvantages, which is why reviewing an in-force illustration with your insurance company before making any decision is so important. Another issue that receives far less attention is policy lapse risk. As insurance costs increase with age, some policies require additional premium payments to remain active. If a policy unexpectedly lapses after years of accumulated cash value, the tax consequences can be very different from what the owner expected. That's why many financial professionals recommend reviewing older, permanent life insurance policies every few years instead of assuming they'll continue performing exactly as they did decades ago.